Hey, thanks for calling in on a wet, cold, very sleepy morning. I know everybody's a little bit shocked to have like an 80-degree temperature change in 48 hours like we had, but it's okay. We'll make the best of it. All right, I'm going to jump right in here. We are recording, so if you have questions, use the mute or use the chat function in the GoToMeeting app, or just text me and I will do my best to get it answered. All right, so we've got a crop report coming up on Friday. A lot of people talking about it, and a lot of people debating what's going on. So let's look at corn, because I think corn could turn pretty bearish pretty quick. So I want to talk about why. Here's your carry out that the USDA said we had in August. They said we had 2.7 billion bushels. So let's be real clear about what went into that, and once we understand what went into it, then we can understand how things might affect it, right? So most people are talking about yield and harvested acres, and absolutely that's critically important. With the storm that hit Iowa, there is a very good possibility that harvested acres can come down. There's also a possibility that yield will come down, and given the decline that we've had in crop ratings over the last 4 or 5 weeks, there's a high probability that the yield won't be 181.8. So is it 175? Is it 179? Is it 180? We don't know yet, and we won't until we get into the field. But what we do know, and this is what's got me a little nervous this morning, this 14.7 billion bushel number on the use column, what we know is that in that number, the USDA is assuming that 5.2 billion bushels of corn is going to be ground into ethanol during the next 12 months. The problem that we have is that at current ethanol grinding pace, we only have 4.8 billion on tap to be ground. And so the USDA is short 400 million bushels off of this number, which would actually put us at a 3.1 billion bushel carryout if that were to materialize. So, three things have to happen, right? Well, any one of these three things can help, but we need something to work to our benefit just to get to this 2.7 number, or this carryout can get larger. So when people get worked up talking about the yield coming down and the carryout getting too small, they're right if these things happen. Harvested acres come down. Yield drops below 180. And or China has to import more. They have to import 15 million metric tons more than what the USDA currently has budgeted in the balance sheet. And that is just to get back to here. So let's look at what our table is, right? So this is the neutral case. This is what the August report said. Here is some assumptions. Let's drop 1 million acres off of the harvested number. And let's just say 1 million acres in Iowa can't be harvested. And then let's drop our yield down to 175.3. Where did that come from? That comes from FC Stone. Actually, that comes from Arlen Suderman, not necessarily FC Stone, but that is his model and what he's putting out. And then if we hold demand even, so we either grind more ethanol or China imports more, then we can talk about a lower carryout. But if we harvest the acres, hit the yield, and don't China imports some but not enough, then all of a sudden our carryout's right back to 3. So if you've been watching the commodity markets recently, you've noticed that oil has come off significantly, right? We're trading back down into the mid-30s. And that's a very concerning sign to me because I don't want corn to follow it. So right now, corn is being supported, and let's look at the corn chart, and then we'll come back to this one. Right now, this is your daily chart of corn. Right now, corn is at its highest levels that we've been at since since March. We've gotten a little bit of a nice bull story coming from the storm, from the drought, from a little bit of help from frost maybe, and the weather in China. So we've got those things working for us. The problem that we have is that after covering nearly 300,000 contracts of being short futures, we haven't gotten any more out of this rally than back to this level. And that is a little bit concerning. And if oil continues to sell off because the driving season's done, or OPEC is producing too much, or whatever, then corn can become very vulnerable very quickly again. So one of the things that we've been doing is starting to price some bushels, and I think we now need to go ahead and work on setting floors and defend this 350 level. I'm not bearish. I just don't like that oil's fallen so much, because I think that makes it even harder to hit that 5.2 billion bushel number that we've got to have to keep our carry out where it is. So, and I don't know what our crop's going to do. So I think it makes sense to set a floor. And this 350 level seems to be a nice, logical floor to set. And there's lots of ways that can be done. It can be done through cash sales. It can be done through options, right? I don't like the idea of being short calls because as nervous as I am, understand that I'm nervous from a risk management perspective, right? From a spec perspective, given this setup, if we're able to break this 363, then I'm in. I want to own it above there, because I think we're going to move straight to 385, 390, and that's going to be that would be a major go signal from a technical perspective. We've got a nice move up to the upside. We're approaching our buy points and buy entries on our oscillators. We've got the funds with a lot of dry powder that they can push it higher if they want. And we've got a crop that seems to be getting smaller. And we've got weather issues in China implying that they need to import more. So there's a bull story, and it's not something to ignore. I just don't want to get so bulled up that we're reckless from a risk management side, and we let we let this thing come all the way back down and rip our head off this close to harvest, because we know we're getting ready to deliver bushels. So whether it's a min-max type deal, a price flip strategy, an outright put purchase, it doesn't really matter what the strategy is as much as just making sure we have some sort of a floor in place, because this setup, it can go either way, and the fundamentals seem to be there to push it both directions once we know what the yield is going to start being. So the next 30, 60, 90 days is going to be very, very important for both this year's corn crop and for next. All right, that's corn. Let's jump to, sorry, I meant to hit a different button. Let's jump to soybeans. All right, beans, very, very different story for beans than corn. I'm much more bulled up on beans than I am corn, and I hope that I'm not fallen victim to just the rally that we have and the groupthink, right? So the USDA said last month that our carryout was going to be 610 million bushels, and that was a huge increase, right, from what they said in July. And what was shocking is that we rallied after that. I mean, we increased this carryout by almost 50%, and we're up $1 from that point. So the market clearly didn't believe this number at all, and left it in the dust. So now we're debating, right? What's the number actually going to be? And here's what the trade is talking about. We've got a lot of yield estimates in the from 53 to 51. But if for some reason that yield were to come in under 50, then we're dealing with a carryout of near 300 million bushels, plus or minus, and that would set it up, set this market up to work considerably higher, especially if China actually increases and beats their numbers. For every purchase that they make, the more the closer they get to actually beating this number. So if we could have the 1-2 punch of lower supply and higher demand and a much, much tighter balance sheet moving into next year. So if we look at the chart on beans, I want to look at the daily and I want to look at the monthly chart, okay, or the weekly, because it's telling us something very, very important. We are straight up here from the last report, right? Here's your August report. We're trading 877. We're trading exactly $1 higher than we were then. But the dollar amount doesn't matter. What matters is how we got there. And we've gotten there with basically straight up. The last 13 days in a row, straight up. No down days at all. Even that was a positive day. We had this little tiny pullback, but we've come right back into this range, right? So the low of this bar here and the low of this range that held in January is 966. If you want to look at where the struggle was on this bar and yesterday's low, or today's low, and where we spent most of the day yesterday, it was this battleground right here, 65 to 69. That was our battleground. What are we doing? We're fighting for the bottom end of this range, right? The bulls and the bears are duking it out. And so far the bulls have won. They're saying, nope, we've got support here. We need to be higher. Now, look at this number right here. The high of this bar is 982 3/4. Why did it turn around right there? That's a question that was bothering me, and I found the answer. I'm going to search this to a weekly chart now, okay? Here's your weekly chart. Where did we turn around? We turned around at 82 3/4 back in January. The low from April of 18 prior to the trade war was 983.5. We came within 3/4 of a cent of that low, and we turned right around on the weekly on the chart, right? So we signed the trade deal in January, and we turn around at the exact point that we broke from when the trade war broke. That was very interesting what happened back there. And so now today, if we're able to take that out and crawl back up into this level, the stage is set for another push higher all the way up to this 1056 level. Whether that happens now or later, I don't know, but the market is putting us into that position to make it a possibility. So I'm going to stay right here for just a second, because I want to think like a risk manager for just a minute, right? Here's 2018, here's 2019, here's all of 2020. This 950 level should be defended. That looks like an incredibly logical place to put a floor. And you can do that. The options were trading at about 12 cents right before I logged on here. So you can get a floor set for 12 cents at this 950 level, leave your upside open, and enjoy the ride, because beans could put another buck onto this thing if things continue to materialize the way that they are. This setup on a weekly chart is very, very bullish. There's nothing not to like about this. If this were a daily chart, we wouldn't hesitate to say that this could continue for another 10, 12, 15 days. And here we're talking weeks, okay? I'm going to go back to the weekly or to the daily chart now, because everybody and their dog is talking about how overbought we are. And they're absolutely correct. this is overextended on your MACD. Your RSIs, your stochastics, all of the traditional indicators are in extreme overbought territory. But understand one thing about technical analysis. The indicators do not dictate the market. The market dictates the indicators. And the market can keep these things overbought or oversold for far longer than you think that they should be able to. So in a move like this, where the higher time frames are picking up steam, your indicators on your lower time frames are persuasive. They're not, but they're not controlling necessarily. So lots of people are talking about a top, sell signals, short it, we're going to crash. It could happen, right? I mean, I'm not saying it can't, but they don't have to. And if you look back at these major bean moves, this RSI can stay above 75 for weeks. The stochastics, the stochastics can stay overbought for weeks and months. And any pullback is going to be bought. So we can move sideways or we can move higher. Is what I think is the most likely to happen. But let's not be stupid and let's spend a little bit of money to defend this 950 level as a floor, right? That would be somewhere in the 880, 890 cash for most places. To me, that makes all kinds of sense. So beans overbought, but we may challenge this 82 level, and we could squeak higher here because the funds aren't looking at the daily chart. They're looking at the higher time frames, and it's not nearly as overbought as this stuff. So pay attention to what could happen there. All right, last but not least, wheat is starting to make more sense. We have this nice run up. Now we have a nice correction in wheat. And wheat is starting to look very attractive from a spec standpoint. We've got the first rally under our belt. We've gotten a sell-off. Buying a turn here makes a lot of sense because we could easily come challenge these highs, especially if corn and beans lead the way. So if we're looking at next year's crop, we've got a lot of rain in the forecast for Kansas and Oklahoma. That's going to make planting conditions darn near perfect. The trade is anticipating more acres, which is why we've sold off here just a little bit. The July contract has flirted with $5. It's been above it. I think the next leg higher, from a hedge standpoint, we want to reduce some risk and make some sales. I think between now and then, we're content letting it play out, and we'll keep looking at the corn market to be our guide, right? If corn implodes, it's going to be hard for wheat to maintain value. If corn rallies, then wheat should get its sea legs and could potentially really exceed, even potentially this 528 high that it made back in April. So pay attention to the dollar. All those things can be impacted, but I think it's going to take 30 days or so before we really have an idea of where we're going to head. All right, that is all I've got for you today. I hope it was helpful. If you have questions, please reach out to us and ask. We are more than happy to help and address any situations that you want us to take a look at. Have a great day. We'll talk to you next week.